we all get successful and we think we're big stuff, but the reality is as well as I say, I still just love the game. So I want to be in it for still 10, 20 years yet. And realizing you're a student, realizing that it's a long play, it's not a short play. So.
Welcome to the Build to Billions podcast, where we guide successful entrepreneurs and investors on the journey from millions to billions. And we believe the key to scaling and compounding your wealth starts every single day with the mindset and practice of stewardship over ownership and applying billionaire biblical principles. Our ultimate goal is to help you scale and compound your wealth and life so you can give more or all of it away to help MVPs. I'm your host today, Brett Swartz. In every episode, we feature some of the world's top entrepreneurs, millionaires, or billionaires. They share their secrets, insights, and wisdom so we can all scale from millions to billions, again, to make a bigger impact and really to grow. I'm excited about our next guest. He's out of the great state of Texas. And he's got a really tremendous background. He's the founder and president of Invest Art Properties. He's also the founder of Multifamily Maestros. And he is a general partner and an limited partner in over 1,000 plus units, representing 350 million in assets under management. He's invested in a total of over 4,000 units in Texas, Oklahoma, Arizona, South Carolina, Louisiana. But he focuses on providing the passive investor significant returns by improving communities, using safe and time-tested approach to multifamily, and also on training others to do the same. Please welcome to the show with me, Mr. Randy, and I'll let him pronounce his last name. Randy, how are you doing?
Langenderfer, Brett, I'm doing great. It's a pleasure to be on your show, man. I really appreciate it.
Absolutely. If our listeners get to know you for the first time, would you give us just a little bit more about your story and your current focus?
Sure. Brett, Houston, Texas, as I said. So my journey really got started in commercial real estate about 10 years ago. I was working for a private equity company in Cleveland, Ohio, and I was afraid I was going to lose my job. I was an executive with a pretty good number on my back for cost savings. And at that point, I really had one of those aha moments that I need to find another income stream. I need to find something to protect my family. Started looking around at small businesses, franchises, et cetera, and had a brother-in-law who came to me and told me he had just been to Armando Montaleglo's flipping school. So I started out in single-family hard money lending, and then came to Houston for business purposes when I landed a job, and started attending every real estate investment group I could and learned multifamily. And once I learned multifamily, I never turned back. I've just really enjoyed the space. I'm all in. Like you said, I've got about 1,300 doors today as a GP, and I'm a limited partner in other people's deals and still like to invest in other people's deals. So I'm doing it full time. I left the corporate world about 2 years ago to do this full time. I don't need to do it. I want to do it, and I enjoy doing it. It gives me purpose for the legacy purposes. And so I'm having a whole lot of fun with life, Brett.
I love it, Randy. Great story, great background. I love the corporate W-2 to the multifamily, not only just passive in some ways, but also active and helping others do the same. So we're going to talk about the 5 secrets to scaling your multifamily investments or business in a minute. But I'm kind of curious, Randy, growing up, what was your super strength or your superpower? Like, what's the thing that was always just kind of easy to Randy? And how do you use that to help people and bless people today?
I think if I was growing up, I would say I was a jock. I loved athletics, football and basketball were the ones. And so that, I didn't play it in college. I played it for a year. But I mean, the reality is what that teaches you, Brett, is team building, getting along with others, and the importance of working in a team environment. Went on to do that in the corporate world of building teams and reaching executive positions. And so it teaches you how to compete. It teaches you how to lose. It teaches you the importance of practice, just to name a few. And so I think I'm very thankful of that background and encourage others to seek their secret, whatever their secret sauce is or their secret power.
I love it, Randy. It reminds me of my days at Marcus and Millichap, multifamily broker to start out of my career. And I remember the practicing the cold call and sitting down in the Monday morning meeting. And then after that meeting, about 30 minutes, that you'd practice the ring, right? And you'd say ring, ring, right? I think about sports. I played football, basketball too growing up. And you practice the jump stop, and you practice the shot fake, and the bounce pass, like every day. Or like even throughout all, from a very young age all the way through high school, it was just like the consistent fundamentals. Talk about the importance of multifamily fundamentals right now, given the marketplace the last a couple of years with interest rates going pretty high. What have you found to be like the core fundamental that's helped to keep perhaps you and your investors a little safer than what's happened?
Yeah, I'm sorry. I got to chime in, man. Your idea of the cold call practice would be more fearful to me than any athletic exercise. But moving forward to today, I would call it back to basics. It's a back to basics and making sure that when you look at stuff and you underwrite stuff. In my mind, we did a lot of stuff that was aggressive in the 2021 era. And today it's back to basics when I'm looking at stuff, and it's got a cash flow day one, and I'm not interested in doing any variable rate debt anymore. I'm looking at doing smaller syndications. I mean, smaller numbers of investors. So I'm seeking high net worth individuals. I want to do one with 5 or 10 people versus 25 or 30. I don't necessarily I focus on the Sunbelt region and looking at that area, class Bs and B pluses and Bs. But so I think smaller syndications of investors, seeking those people that I'm trying to get along to come alongside of me, finding great properties, but just making sure they underwrite day one and take the shenanigans out of it.
Okay, that's good. So sounds like back to basics, got a cash flow, right? And then also moving from 25 to more like a 5 to 10. Talking about basics, I think sometimes some of the basics get forgotten, Randy, or they get taken for granted, right? For example, like you mentioned, the variable debt. I call it not just having a cash flow mindset, but having a tax flow mindset, also a debt flow mindset. And each of these are very, they all connect to one another, but they're distinct, right? And I call this being able to invest in 3D, where most, if they're just focused on one versus the other, then they can get in trouble, right? Like we've seen recently with these interest rates and people that overpaid and took on too much debt, and then now it's sinking the ship, even though other things are going well. So is there any part of the basics do you feel like was forgotten in the last couple of years that you really want to point out?
I think one of the ones is cash flow. The other one I would say is debt, matching the debt with the business plan. But the first started in the cash flow. We looked at flipping multifamilies for that time period. You buy them, hold them for 2, 3, maybe 5 years, and flip them, and hopefully make a ton of money. Those are still available, but in few and farther between. So that's why I think the essence of cash flow. If you're creating cash flow and you're paying your investors and you're paying all the bills, you can hold on to it and weather out the storm, whatever the storm may be. And the other one is, Brett, is matching debt to the business plan. If you're going to if you plan on truly holding the property for 5 years, don't get fixed rate debt on it for 10 years then. Match the business plan with the debt, whether it be 5, 7, or 10 years, and make sure your investors support that thesis that you're going to hold it for 7 years or 10 years. I mean, it's kind of simple stuff. It's back to basics again.
Okay, so I agree with you completely. So what would you say the number 2 secret is after back to basics? What would you say, Randy, is the one that will help us, either scale our multifamily business or investments?
Back to basics, I think building a very solid team, and that team is multifaceted. That team has investors, it's business broker relationships, it is fellow GP partners, finding partners that have something you don't. I'm a finance, CPA, MBA kind of guy, so I don't want another person like me on my team. I want a marketer or somebody that can complement. We can complement each other. then you're looking at finding, the team consists of the next layer down as property management companies in the location of what you're looking at, making sure you have great relationships with multiple firms in that area, wherever that region is you're looking at. And so I think those, you master those and you're off to a really good start. You've eliminated a lot of variables and a lot of risk.
I think that's huge, right? I think about like 5 Steph Currys or 5 Shaquille O'Neals or, 5 Kareem Abdul-Jabbars, like whatever, right? You want to balance, right? You want a balance of gifts and talents. Although 5 Steph Currys might be the one that would break the system, right? Because he could shoot it from anywhere, anytime. But yeah, I mean, it sounds like a balance of broker relationships, balance of people who are focused on capital raising, people that are focused on the numbers and underwriting, operations, right? Broker, broker relationships, but basically a balanced team, right? Is just as important as a good team, right? Where that really, that's the essence of it. It's not everyone having the same gifts. So how have you best been able to build that, or any tips or wisdom for making it a win-win in partnerships and such?
But I think back to the misused Sports Illustration, it's the Bulls, right? It's Scottie Pippen and Michael Jordan. They were opposite type players, but they grew together and they complemented each other. I mean, they're the best example to it. And how you find there's no given secret. There's no single purpose or reason to how to find partners or those. It's in my mind, it's old fashioned blocking and tackling. When I'm looking for partners today, it's a ton of networking. One of the partners we did a building with the other, I would say we dated for 2 years in advance of getting married on property to make sure that we were equally yoked and had the same mindset. And it's just old fashioned networking, going to conferences, meeting with investors wherever you can and picking their brains as to what they want. What do other general partners want if you're going to partner with them? Like you said, are they all focused on cash flow or the total package that you just summarized very nicely? I think is you got to be equally minded, right? It's like a marriage. You're going to be married for 5 or 7 years. One of my mentors told me a long time ago, partners are like a marriage. They're easy to get into, but expensive and painful to get out of. And so it is with business partners as well. So take your time is what I'm saying, and make sure you can be different, but you got to be on the fundamentally matched. It's just like a marriage.
Excellent. Yeah. And that's such good wisdom. Yeah. Take it slow. Right. And I like the idea of going to these events together, going to obviously the properties and underwriting them together, and maybe even investing into some passive deals together, and so that you guys can get a sense for which deals you like and what you see, and basically get some reps before you go on a date before you get married, right? At least go on a number of dates. I think that's lots of wisdom. Okay, great. So building a team, back to basics. What's the number 3 secret you would say to scaling your multifamily business or investments?
I think today it's really one of the ones I'm really focused at is markets. So many people try to, I use a shotgun approach and look at multiple markets, and that's not bad if you've got a large team maybe, but even if you've got a large team, the best multifamily people I know of do 1, maybe 2 markets, maybe 3. I'm thinking of the one person I met, I forget his name, Orlando. He owns the Orlando market. He's got 5,000 units in Orlando. It's going to be difficult for anybody to compete with him because he knows every location. And so I try to concentrate on Texas and some Arizona, Tucson specifically. I've got a partner out there that we really like, Tucson, but Texas, Houston, and Dallas. The numbers, I still can't find a place better than Texas yet to compete with the population growth, the income growth, and the lower cost of living. And so that draws tremendous business to Texas, as everybody knows. But until I lived here, I heard about it. You just can't until you see it. I mean, the neighborhood I live in, I can give you a couple examples off the top of my head, but it's crazy growth. So you're going to minimize your risk there. So, but I think the third one I would say is capital markets. What markets? Not capital markets. Markets of where you're going to focus on. Focus on 2, max 3. So if you got a partner that wants to go to Topeka, Kansas, I'm not in those markets. Thanks. Unless they've got a ton of experience there, and as we said, have thousands of units in Topeka, Kansas, then I might leverage their experience. But focus on a few rather than many.
Yeah, so focus and specialty and niche down on a particular geographical market. By the way, speaking with Mr. Randy, and you can go to multifamilymaestros.com, multifamilymaestros.com. If you want training and mentoring for multifamily apartment investing, you can check that out. He's also invest-arc.com, invest-arc.com for more information too on Randy. So, excellent. So those are 3. I'm curious, we talk about Texas for a second. So, property taxes, right? And insurance costs, some big headwinds the last couple of years. You go and you try to have them reassess, and you say, hey, it's not worth what it was worth. And they give you maybe a 10% off of what they're, the new 50% more than what you paid for it. And all of a sudden this thing is taking on, the water on the ship, and it's sinking the ship, so any other thoughts on the whole Texas property tax, headwind that a lot of multifamily investors are facing?
Well, it's not just property taxes, insurance. That's the other one. It's property taxes and insurance. And as you indicated for your audience, Texas does reassess every year versus other states. And so it's just a business practice that you contest whatever the local area assesses your property. It's automatic contesting. And sometimes you win and sometimes you don't. But sound underwriting would be the finest thing. You got to just plan for it. I don't know how to say it. It's just contesting it and making sure that you fight it every year on multiple bases with professionals. Don't try to do it yourself. Obviously, I first year down here, I tried to do my personal property on myself. I don't even do my personal property anymore. I have a company that contests it for me. But yeah, you got to write that. You got to write that into your business plan too. So in your underwriting, so if you're going to see the rest of your expenses go up 3 to 5%, I'd write up taxes 7 to 10% a year. And right now they do come down periodically too. So that's going to happen at some point. It's begun a little bit. I think the other side is the insurance side. Because we are a coastal state, we've gotten beaten up like Florida and other coastal states because of the proximity to hurricanes. And there's a lot of carriers exiting the market. So there are fewer companies underwriting insurance in Texas, also raising prices. And, there's no trade secret there other than you're trying to get a good property manager where maybe you can leverage their portfolio insurance rates. We rebid it every year, our insurance. We go out and talk to agents and see every year what the market's bearing. There again, I say that's going to come down sooner or later. There's going to be more firms coming back into the market one day because all we need is a couple good years without a lot of major hurricanes. And that might begin to happen. But no, it is a fact of business. But I'd much rather be in Texas still than I would in the other coastals, the New Yorks or the Californias, and have rent controls and those objects. So,
yeah, I agree. That's part of why we left California a couple of years ago, due to the challenging ways to do business there in that state. So 7 to 10% is the increase that you want to underwrite for property tax. Is it the same for insurance? Are you doing 70%, 10%?
It might be a little bit less. I don't know. They're both going to vary depending on where you're at. If you're in one of the 4 metro areas, Houston's going to be higher than Dallas, et cetera. So yeah, I would say 6 to 8% probably for insurance.
Okay.
But that's a safe number. My point of it is you want to budget higher or underwrite higher than your normal
Yep. Makes
expense
sense.
growth.
Let's move to number four. Secret to scaling multifamily business or investing. What secret do you have there?
Um, one of the there's a lot of different ones there, but I would go further into that education arm. That I think there are so many people that high net worth that want to get into real estate and they um, don't have the time to spend on it. Or that's great if you want to be an LP and you want to just invest passively. That's great. But if you really want to be active in this, I mean, you and I probably spent tens of thousands of dollars on our college education. And why don't people spend money on getting multifamily education? And this is wherever you're at. Maybe if you're advanced and you got thousands of dollars, or, I mean, I attend conferences, I'm still getting education. So it doesn't have to be formal education, but I think there's value to some of the people newer in the market that want this to learn from those who've gone before you so you don't repeat their errors and that at least you're not going to repeat the errors they made. And you get ahead of the game and, you leverage their network, which is awesome to get started. And so education is really big in my mind too.
I think that's huge. I think and you're right. You think about it, you spend, 4 years studying stuff that, say 98% of it doesn't really necessarily apply. Maybe 20% does, depending on if you're in the multifamily space or investment or entrepreneurial space. And then how much continuing education do you spend every year networking and connection with those that are live, masterminding with those that are in the business with you now. I think that's so key. Okay, excellent. I love that. That makes sense to me. What about number 5? What's the last one? Round it off.
5 is I think stay in the game, persistence. It's not a short-term business. There are so many people today wanting to get into the business that just want to make a quick buck. One of my colleagues has a motto of "Go fast, go quick." I'll get rich, get quick. And I'm diametrically opposed to that. I think people need to take the long haul, look at it as a go slow, go steady. But as one of my mentors told me, Randy, this isn't something you need to reinvent the wheel on. You just need to follow the playbook of those who've gone before you. So go steady, but continue to be in the game in up and down markets. And no matter what kind of market it is, be in the game. And I think over the long haul, you're going to be rewarded very handsomely.
Excellent. Speaking of like staying in the game, I want to talk a little bit about tax flow and timing with capital gains tax, Randy. So it starts with a story of a gentleman. He had multifamily properties, about 8 properties. This is in Northern California before the 2008 crash. He did lots of 1031s, took on a lot of debt. And he found himself in a situation where he was cash out refining, buying new deals, 1031ing, maybe being a little more aggressive than he wanted to be on these properties. And the market stopped and he lost everything, $15 million worth of real estate. And we said we felt like the challenge was he couldn't exit in an efficient way and get out of debt without getting crushed by the tax. Right. And so can you talk about the challenge of the 1031 exchange? And at times it can put you in a compromised position because, you're selling maybe high, but 45 days later, you're having to identify and, close on something 180 days. And you're like, was it worth selling and buying in the same marketplace? So walk us through the 1031 exchange challenges that you've seen over the years.
Well, I think, you summarized it pretty well there. I mean, it's a matter of timing. It's a matter of, as you know, you have to have a new property within 45 days identified. That can be a challenge. And again, depending on what markets you're in, I see a lot of people, we in Texas look for those 1031 buyers because they're going to come in and pay more than a normal buyer would, a fiscal buyer. So you've identified it very well. I mean, it's the timing. And then just the eventual taxation, you're deferring it, but you're not eliminating it. You are going to pay it. So there has to be a very thoughtful and meaningful exit, unless you're just going to leave it all to your heirs one day when you die and let them figure it out. But the government gives it to you for a reason, because they're going to get it to you at a higher cost later and a higher basis, a much higher gain. So be careful of those ills, and it has to be a methodical process, just like any other buy process. So, and I think the air problem I see is a lot of people just leave it for the heirs to figure out, or if they're family offices or they're large net worth people, and that's the wrong thing to do from an estate planning purpose.
Yeah. So let's talk about a little
Get
bit
some
more
good
here.
advice.
So after the aftermath of that crash, and this gentleman named Steve losing everything, he went bankrupt, lost his marriage, lost all of his properties.
Ooh.
And we said, there's got to be a better way than just this 1031 and cash out refi and just, charging forward and buying so many deals. There's got to be a way to sit on the sideline tax deferred without, having to do a 1031 exchange. And so we learned about something, Randy, that allows, through an installment sale with the trust, to eliminate the need for the 1031 exchange. And we recently just did it for, in Texas, a $17 million land sale for some farmers. I did it for a $8 million, a business sale up in Massachusetts. We've done a $8 million deal in Palo Alto. So a lot of deals now, but the key is the client can get what they really want, which typically is truly passive income, capital gains tax deferral, diversification, debt freedom, and some liquidity, all without having to necessarily leave real estate all the way, right? But they can do it in a passive way. And so we work with purpose-driven entrepreneurs and investors who want to exit and want to work with like a Randy who has the deals and the underwriting and the patient and the general partnership. They want to be LPs, but they don't want to suffer the tax consequences. And they also, may not be eligible for a 1031 exchange and do some kind of like tick carve out, which can also be very challenging to line everything up. So it's changed people's lives, right? And so I talk about this is our company. We founded it called Capital Gains Tax Solutions. And the thesis is eliminate the need for the 1031 exchange, sell high and buy low when it makes sense for you. So as an example, we did a $13 million exit about 2.5 years ago out of San Diego. And we paid off all of the debt. We deferred all of the tax, and we started to put it into real estate, but we put it into the lending side of real estate, which was about 10+% return on our money. And we waited for the real estate market to shift down, and start buying stuff on a more of a discount, more of a buyer's market as the 6 months, 12 months, 18 months went by from the lows of the interest rates. And so we call this tax flow, not just cash flow, all tax deferred. And then, but they're also entrepreneurial. So they'll eventually buy the land and develop. They do car wash developments. They'll eventually buy land and develop again and be an active investor again, all tax deferred. And so it works for the entrepreneur, works for the passive investor, but we call it the Netflix to the old Blockbuster 1031 exchange. Okay. And it changes people's lives. But I'm always surprised that a lot of folks just haven't heard of it. They don't know how it works. And I didn't even know about it until after in 2000. I had to learn about it in 2009 after the crash. I was at Marcus and Millichap. And we thought we were the Navy SEALs of multifamily investments, of brokerage, of 1031 exchanges. And we got humbled pretty quick. And I'm seeing it happen again for people who overpaid a couple of years ago. These teaser rates have expired. And now the debt and the insurance and the property tax is sinking the ship, right? And it's sad because people are losing, half or all of their money all over again. And I go, hindsight's 2020, but I do think if more people knew about this, they wouldn't 1031, they wouldn't have overpaid, and they would have gotten out.
The first question I got for you is, we're going to hear more. That's the first I'm hearing about that strategy. That's a great one. That is, and I was also thinking, as you were saying, I don't know, you need to write a book or get it out there more someplace, because I've never heard that mentioned from my financial advisor or anybody else.
Yeah, we actually did write a book on it, Randy. I appreciate that. It's called Building a Capital Gains Tax Exit Plan. And we built a company around it, and we exist to unlock capital gains to multiply freedom and impact. And what's pretty wild about this is in the next 15 years, we're set to next 15 years, about 84 to 100 trillion is set to transfer from the baby boomers. It's the largest
Yeah.
wealth transfer in the history of the planet. And a lot of these folks have these highly appreciated assets, and they don't want to, just die and have their kids get a stepped up basis. They want to get out now. They're tired of the toilets, the trash, the termites. They want to get out of the coastal states. They want to invest in places like Texas and Florida and Georgia and North and South Carolina, but they don't have the expertise. They don't have the team. They don't have everything we've been talking about. But if they had a bridge to capital gains tax deferred and to diversify into mobile home park, multifamily, real estate debt, we think that is the way to properly diversify within real estate. Keep some liquidity too. We have some liquidity stuff. We have some debt stuff that you can get out in about 30 days. It's paying about 10% in real estate. But the point is, like, this massive amount of wealth that's transferring needs a new solution. Now, the good news is our solution goes back 30 years, thousands of transactions. It's been through all the audits. But the second part of the solution, which I think is interesting, Randy, you talked about estate planning, is it eliminates the estate tax. Most people forget about this, and they also forget that these exemptions are the highest they've been in many, many years. In fact, it's about 28 million married, about 14 million single. That's set to expire in 2026 and cut in half. We'll see what happens with the new administration. They might extend it or something. But even so, if you have a stepped up basis, it doesn't solve for that. The death tax is above and beyond the exemption amounts. So we have a strategy, it's our 2.0 version of this, that eliminates the estate tax without any life insurance, gifting, or insurance required, which is really expensive to get insurance, right? Yep. It doesn't give up any of your lifetime exemptions. So I think these are the conversations that are the bigger pieces for the legacy play that I feel a lot of folks that have already made that first, couple $1 million and they're in the billion number, like they got to have these solutions. Otherwise, the death tax is going to crush them. And the 1031, they might overpay on a deal.
And we both know it's not how much you make, it's how much you get to keep. So that's important. You got a great strategy.
Thank you. If people want to learn more about that, you go to capitalgainstaxsolutions.com. It's capitalgainstaxsolutions.com to get started, get our free ebook. And you need to have a deal, at least $1 million net proceeds, $1 million gain, but it can be Bitcoin. It can be a business sale. It can be real estate, primary home or investment, stock, any asset of any kind. Go to capitalgainstaxsolutions.com. All right, Randy, that being said, are you ready for the lightning round?
Let's do it.
All right. Knowing what you know now, if you can go back to your 20-year-old self, what's the one golden nugget make sure to tell yourself to do?
Get started. Take action. Don't procrastinate. I'm an analytical type, and my mindset is one that is notorious for overanalyzing.
Excellent. Take action. Question number 2, what's the number one book you've recommended or gifted the most in the past year?
Actually, I've done one. I have 2 books. On a personal side, on personal faith, I believe in the Bible and read the Bible every day. On a business side, it's one right up your alley. Splitting Heirs, HEIRS, Splitting Heirs. It's a estate planning book, and all about letting people know about it. What they should be planning for, because that's another one that 90% of the people, when they get to be in their 60s and the 70s, I don't want to think about that stuff, Randy. I want to go out and have fun. I'm going on cruises and I'm doing this or that. Don't leave it to your heirs to figure out.
Great wisdom. Yeah. Stewardship over ownership. Question number 3. What are you most curious about right now?
Wow, that's a great one. Most curious about where America's going, and are we headed towards a global recession or a global world war?
Yeah, that's spot on. Curious about that too. Question number 4, number 1 leadership quote or theme that you strive to live by.
I'm a big Stephen Covey fan, and I think with all the ones he got in my head a long time ago was beginning with the end in mind. Would be one that I recite to myself. So when you're going into a business transaction, we all get excited. We all love the chase, but think how you're going to get out of it too. And what's the end going to be like?
Perfect. And the last question to kind of wrap. Oh, actually, second last question. Are you using ChatGPT?
Yes, I've started to do more with that. I just got a new phone yesterday, and I spent half the day just being intrigued by all the built-in artificial intelligence they have into it. Yes, so I use artificial GPT. I use it whenever I write stuff. It's phenomenal. I'm not a good writer. It's great that way. I've also learned recently about deep research, paid subscription to ChatGPT for deep market research. Incredible. Some of the results are getting back for $20 a month.
Spot on. Love it. Last question. After all your success, helping all the people you've helped and building all the business and wealth you've built, how do you best stay centered in your values and then also keep a mindset of stewardship over ownership?
That's, that we all get successful and we think we're big stuff, but the reality is first of all, I said I'm a person of faith, so I think that grounds me pretty well to realize that the majority of my assets I'm going to give away one day, and my estate planning. I've also, like a lot of guys, have a wife who grounds me pretty well and humbles me daily for all my bonehead mistakes, and so I think those are the big ones. As well as I say, I still just love the game, so I want to be in it for still 10, 20 years yet. And realizing you're a student, realizing that it's a long play, it's not a short play. So,
Randy, I won't even say the last thing again. You'll say it at the very end here. I want to just thank you for being on the show. I want to thank you for sharing your wisdom with us. I want to thank you for your passion for helping people get, wealth and freedom with multifamily through a business or through investing, sharing with us 5 key secrets and wisdom here to scale our multifamily business or investments. Keep doing what you're doing. And for our listeners who want to get in touch with you, can you remind them one last time, what's the best place for them to find you?
Well, Brett, let me start by first saying thanks. It's really a privilege to be on your show. I know you got a great audience. Invest-arc.com. Invest-arc.com is my syndication business. And Multifamily Maestros, all one word, we'll put those in the show notes for you, is our mentoring education business. I hope you have a great day, and I thank you a lot again, Brett.
Awesome. Thanks, Randy. I also want to thank all of our listeners for listening to another episode of the Build to Billions podcast. We're also streaming on Capital Gains Tax Solutions podcast and YouTube channels. Please subscribe there. We have tons of great content, deep conversations like we just had with Randy on investing, on leadership, on growth. Make sure you also, if you have a massive capital gains tax potentially coming up on a sale, that you get with us early. We need to set this thing up before you exit. Check out our best 1031 exit plan that gives you a regular 1031 exchange and our strategy as a backup plan. Just go to capitalgainstaxsolutions.com to get started. That's capitalgainstaxsolutions.com. Appreciate everybody, and we'll talk to you soon. Bye now.